Hi, Tony from 000 Property, and joining me today is Shawn Mcannalley from Mason Finance. Today we're going to take a little bit of a deep dive on lending opportunities in the market. Shawn's going to help us out with some really great insights into how best to leverage your opportunities when it comes to borrowing from the banks. Shawn, thanks for making the time, mate.
Thanks very much for having me, mate. Much appreciated.
So traditionally, people would say 20% deposit in order to buy a property. Is there an easier way to get into the market?
Yeah, look, Tony, there is, and this is probably one of the most common questions we get from clients, and especially young clients entering the market for the first time. Their question is, do I continue to save up that 20% deposit, or do I just commit and pay that lender's mortgage insurance? So, as we know, the property market is moving along quite quickly, so to be able to save up that 20% will take quite some time. So, yes, sometimes lender's mortgage insurance is required. However, we do have a lot of actual LMI waivers, so where clients, if they're in certain professions, doctors, nurses, teachers, even just people that work at a school, there's a lot of LMI waivers where they can actually avoid paying lender's mortgage insurance altogether, simply by being in that profession. So easiest, quickest way to get in without paying LMI, using a waiver. Alternatively, yes, using that LMI if required, but it is a way to get into the market, and as we know, getting into the market is the hardest bit. There is a bit of a cost involved sometimes, but utilising these LMI waivers is a good way to go about it.
So with those LMI waivers, what sort of a deposit will someone need?
Well, look, 5% is all some lenders require. You can save up to 5% deposit plus your costs, and that allows you to enter that market. Investment properties, a lot of lenders will require a 10% deposit, but we do have lenders as well in the investment space who will allow a 5% deposit.
That's excellent. What sort of money would someone be saving, let's say on a $750K purchase, if they don't have to pay LMI?
With a 5% deposit, no LMI, you're probably saving around that $20,000 to $23,000 in lender's mortgage insurance, depending on the lender. Now, that LMI is calculated, and it is different from lender to lender. And the bigger deposit you have, the less LMI you pay. But yes, effectively you're saving, potentially saving $23,000 in LMI.
Right, that's incredible. What an awesome opportunity. So Shawn, can you tell us a little bit about how guarantors work when it comes to lending?
Yeah, of course. So look, effectively it's called a parental guarantor. So the parents generally of the applicant will be using their property as security for the children to utilise that equity in that property to purchase or build that next property. So the best way that I explain it is as if you own a property already and you're going to purchase your next property. So you use that property as a security to purchase the next one, so utilising that equity. Whereas with a guarantor loan, you're effectively using your parents' property to use that in that security and the equity available to purchase that property for you, for the children. Now, typically what we do is we'll structure the deal as well, or the loan, as if there's a 20% loan split secured against the parents' property, and then the 80% against the children's property. So that way the kids can focus solely on paying down that 20% loan split, and then once that's paid down, that property gets released, and then they can focus on paying down the remainder 80%.
So in a world where the bank of mum and dad is a real thing, the equity bank of mum and dad is also pretty handy.
Yeah, absolutely. Yeah, we're seeing a lot of parents who are actually gifting funds to the children to actually help them get into the market, but also, yes, using their property as security is definitely a massive leg up for a lot of kids to get into the market as well, and we're seeing that more and more often now.
So Shawn, something that I talk to a lot of clients about at the moment, especially clients who can't necessarily afford to buy where they want to live, but are happy where they're living and still want to get into the market, is rentvesting. How can a broker help a client when it comes to looking at rentvesting?
Yeah, look, this also we're seeing a lot more of these days, and especially where children or young applicants are actually still living at home with their parents. So when kids are still living at home, we use what's called notional rent, generally around $650 a month we need to allocate towards that living expense, but then we're not including any rental expense. So it just boosts borrowing capacity for the applicants. They may not want to live in that property, but they want to get into the property market. So yeah, the rentvesting is a great way to go. It just allows for, again, a higher borrowing capacity. They can purchase somewhere that's in a high growth corridor. They can see the benefit and the long-term capital growth that they're going to see from it. And assist them to get into the market sooner.
Yeah, great strategy. So Shawn, post-COVID, we saw a lot of people from capital cities start to move to regional areas or just to places where they really wanted to chase a better lifestyle. We've continued to see that, and on the Sunshine Coast specifically, the internal migration the past few years, I mean last year it was 14% of the national internal migration was to the Sunshine Coast, and after the first quarter this year we were already at 5.8%. What are you seeing, and how is that impacting lending and the market?
Yeah, look, we're seeing similar signs. There's a lot of, everyone wants to live on the Sunshine Coast or South East Queensland in general. The infrastructure that's going ahead for the next, sort of 8 years that we've got in the pipeline, it's just driving migration. Tradies are moving here. We're seeing, and I'm actually seeing a lot of New Zealanders moving here, probably one in 6 applications that we put through from New Zealanders that have recently moved here. They're setting up here, or they're wanting to actually move here and they're still in New Zealand. So we've got lending options for applicants who are actually still living in New Zealand. They're actually building investment properties here. They're gonna have that as an investment property until they move over. Then they'll convert that and move in. So similar to what you're seeing is just a massive influx of young working families who are wanting to build their lives in South East Queensland and Sunshine Coast in particular.
And so New Zealanders living in New Zealand have access to lending facilities where they can purchase an investment property here in Australia?
They do, yes. Not many lenders do it, but we do have either expat lending or foreign income lending. So yeah, there are a couple of options there. It is a little bit trickier. They need to be in a strong financial position and lower LVR restrictions, but yes, it is possible.
So the sunny coast, the new Bondi, for my Kiwi mates, if you know, you know. So probably one of the most exciting things for investors and owner-occupiers alike, anyone going to that lending space, has been a drop in interest rates. And the forecast looks really strong. What are your thoughts and what are you seeing?
Yeah, so look, there's another meeting coming up shortly with the RBA. Everything's pointing towards another 0.25% decrease. That's my call. And fingers crossed it does. So look, every 0.25 decrease on an average home loan or an average couple, solid income, $100,000 each for mum and dad, 2 kids and a credit card, boosts borrowing capacity by about $25,000. So it definitely allows for higher lending, but it just also opens options for the clients to be able to purchase where they want to, not so much having to purchase where they can afford. So yeah, look, I'm seeing more and more rate decreases, and look, banks are pretty competitive, and across all of the lenders, there's not much difference in what their variable, owner-occupied and investment home loan rates are. So they're all pricing pretty well. Some banks, they sort of pull the lever and try and bring in more business by lowering interest rates slightly, by increasing their discounts. So all the major banks that we go to, for all of our clients, we put in what's called a pricing request as well, and that's saying, hey, we can see you've got a competitive interest rate there already, but what is the best interest rate you can give us? And typically we get a little bit shaved off that overall interest rate as well.
Yeah, excellent. Now we know the lending space is very competitive. What are the top 3 reasons someone should work with a broker?
All right, top 3 reasons, I would say one is just the options we have. So as a broker, we'll have maybe 45 different lenders that we can actually go to. Now, the benefits of having multiple lenders is one, obviously the interest rate. So brokers, we have to abide by what's called best interest duty and take the client to the most suitable lender. So if you go direct to the bank, well then they've only got what their product is and they have to effectively give you what they have. So interest rate, obviously if you're with Bank ABC, your interest rate is 6%, you come to a broker, we've got banks that are offering say 5.5%. So repayment figures, interest rate, that's one benefit. Probably a second benefit would have to be valuation. So because we have access to all these different lenders, we know which banks actually value a property higher than others. So let's say you're going to buy an investment property and you want to release some equity for that. If you don't have equity with one bank or sufficient equity with one bank, we can have a look at another, order the valuation with them. All of a sudden that valuation is $100,000 higher. You've got $100,000 more equity to play with. So that's probably 2. And 3 is simply just the ease for an application. Now, if if you're going to say buy an investment property and you've got a contract on it and you need to have that finance approved within say a 14-day period, well, we know which banks to go to, which banks to stay away from. We can see their SLA or their service levels, and we know which ones are going to turn it around quick and which ones are going to take 20, 30 days to actually process it. So when things have time constraints on them, we know where to go and where not to go.
So variety, flexibility, and then simplicity. Going through the process as I am right now, I have to agree with all of those things, especially the simplicity, not having to follow a checkbox system where I have to think of everything. Shawn, as you know, we're experts in the property side of things. That's what we do well. You're fantastic in the lending and the brokerage side of things, and due to that, we're comfortable introducing clients to each other. Me when I've got a client who needs that assistance with lending, and you when you've got a client who's thinking about investment. You recently introduced me to a fantastic couple. Well, they're actually a beautiful family getting into their first investment property. Do you mind if I ask, or do you mind if you share why you were comfortable introducing them and what sort of a strategy you've worked on with those guys?
Yeah, not at all. So look, I've had these clients for quite some time, and they've recently come back to me and just saying, hey, look, I think we're in a position to to start our property investment property portfolio. So we sat down, crunched some numbers, and yeah, look, they're in a great spot there. So they knew they wanted to do something. They didn't know what they wanted to do. They like property. They've owned property before. They like it's a tangible asset. They like that they can see, touch, and feel it. So I said, look, have a chat with Tony at 000 and just see what you can do. Start the communication. So that's when obviously you had a chat with them, and there was a few sort of good investment opportunities for them that really suited what they were looking for. It looks and they're going to be moving forward with one of those options, and I think that'll set them up long term for their financial security in future.
So Shawn, one of the advantages of working with yourself and Mason Finance is not just to secure lending. I've noticed personally, and any clients that I've referred to you, is that you actually knuckle down on strategy and you look at the bigger picture, whether it be tax benefits or how they can best structure their lending to get the most bang for their buck, so to speak. So when someone's talking about, and quite often we'll have a client who will be a little bit nervous using their personal property as security against an investment, but what is the best strategy? Is it to pay down your investment loan quicker? Is it to have more money sitting in or more debt sitting in your personal property? Is it to have more debt sitting in your investment? What would you advise there?
Yeah, so look, at each individual clients, they're all different. It all depends on their risk appetite, their financial position at the time, their age, what sort of assets and financial situation they're in at that time. And we're working closely with their accountants as well, and work out that strategy and the ideal strategy for them. So for example, I've got one applicant or client at the moment, young lady, who she has an owner-occupied home loan, very low amount of debt on it, and then she has an investment loan with a lot of debt on it. She was considering, do I pay down my owner-occupied debt completely and close out that loan and then focus on the investment? This particular case, we said, look, how about you just release equity from your owner-occupied home loan for investment purposes? That was her 20% deposit plus costs, and then she borrowed the remainder 80%. So in that way, it's sort of keeping her investment debt high and her owner-occupied debt low. The reason being, owner-occupied debt is non-tax deductible, investment debt is. So it just gives her a better result, and we do that sort of forecasting and work out the benefits come tax time. She was on a good income, so she was paying a large amount of tax. So yeah, all that strategizing really comes down to the individual, but we definitely sit down and work out the best way forward.
And I can actually personally attest, a couple of the clients that I've referred to Shawn have come back with strategies and an option where refinancing and shifting things around a little bit is saving them. I think one was over $12,000 a year in tax benefits alone. So well worth having a chat to Shawn to best understand whether or not A, you're doing things right to begin with, and B, what you can do better to get the most out of your lending.
Yeah, absolutely. And look, debt recycling is something that we're big on, and sort of consolidating debt and debt recycling. It just provides them, a lot of options, but then obviously lots of tax benefits come tax time.
Mate, thanks again for coming in today. Some really fantastic insights there. If somebody is thinking about lending, I would thoroughly recommend they give you a call. It's a really good opportunity to get an understanding of what's possible, but also to work on a bit of a strategy around how you can get stuck into the property market. Really appreciate it.
My absolute pleasure. Thank you, Tony. We should do it again soon.
Let's do it.